I need you to understand something before I show you the numbers. What is about to happen in the next 3 weeks has never happened before. Not in 1980 when the Hunt brothers tried to corner silver, not in 2011 when the first silver squeeze failed, not ever. Because in 1980 they changed the rules and crashed the market. In 2011 they raised margins 5 times in 9 days and crushed the rally. But this time they cannot stop it, because this time the math does not work. And when I show you the evidence, when you see the inventory numbers, when you understand what happens on February 27th, you will realize why some of the smartest money managers in the world are calling March 2026 the funeral of COMEX. Let me show you what they are hiding. It is early February 2026. COMEX has around 103 million ounces of registered silver. That is the deliverable inventory, the metal that can be used to settle futures contracts. But March 2026 open interest represents 429 million ounces, 4 times the available supply. Now, normally that would not matter, because in a functioning futures market, only 5% to 20% of contracts stand for delivery. Everyone else rolls forward or closes for cash. The system works because nobody asks for the metal. But in February 2026, something broke. Out of 19 million ounces of open interest in February contracts, 18.7 million ounces stood for delivery. That is a 98% delivery rate. Read that again. 98%. In a market where 10% to 15% is considered high, and where 20% is alarming, and where anything above 30% has never happened in modern history. February 2026 hit 98%. This is not a futures market anymore. This is a run on the bank. And it gets worse. January 2026 saw 49 million ounces delivered. In a month that typically sees 6 to 7 million. That is 7 times normal. 7 times. In a single month, that is not even a major delivery period. December, March, May, July, and September are the traditional active months. January is supposed to be quiet, a rollover month, a time when traders extend positions into March without taking metal. But January 2026 delivered 7 times the historical average, and February is on track to be even worse. People are not rolling contracts forward to March anymore. They are rolling backward to January and February, skipping March entirely, demanding metal now, even though it costs them more, even though January is never an active delivery month, even though they have to pay premium prices to get immediate settlement. They want the silver in their hands before March arrives, because they know something. And now I am going to show you what they know. COMEX registered inventory has been draining at 785,000 ounces per day, every single day. Since October 2025, inventory dropped from 167 million ounces to 103 million, a 38% collapse in 4 months, and the drain is accelerating. In the first week of January alone, 33 million ounces vanished. That is 26% of registered inventory gone in 7 days, 1 week. On January 7th, a single day, 3.2 million ounces were withdrawn with 0 ounces deposited. 0. Not a single ounce came in, only withdrawals, only metal leaving the system. If the current drainage rate continues through February 27th, which is first notice day for March delivery, COMEX will have around 85 million ounces left. Maybe less if the drain accelerates. Maybe 75 million if panic sets in. But here's the problem. If only 25% of March contracts stand for delivery, COMEX needs 107 million ounces, more metal than they will have. And February just proved that delivery rates are not 25% anymore. February hit 98%. January was close behind at over 80%. If March sees even 50% delivery rates, we are looking at demand for 215 million ounces, against available supply of 85 million. The math does not work. It cannot work. And on February 27th, when first notice day arrives, someone is not getting their silver. Now, let me show you something that should terrify anyone who understands how these markets operate. The backward roll. In normal futures markets, traders roll forward. You hold a March contract. March is approaching. You do not want delivery, so you sell March and buy May, or sell May and buy July. You push the contract forward into the future. That is how commodity markets have operated for over a century. But in January 2026, something unprecedented happened. Traders started rolling backward. They sold March contracts and bought January contracts. They paid a premium to move into an earlier delivery month that was already expiring. On a single day in early January, March open interest declined by 450 contracts, while January and February rose by a net 355 contracts. Traders were paying extra money to get silver sooner. That has never happened. Not in the Hunt brothers era, not during the 2011 squeeze. Never. Because it makes no economic sense unless you believe the metal will not be available in March. Unless you think COMEX is going to default. Unless you know something the market does not. And here is the proof they know. January 7th. That was the day the data showed something mathematically impossible. On that day, 1624 January, silver contracts received delivery of 8.1 million ounces. JP Morgan issued 99% of those delivery warrants. Almost all the metal came from one bank. But here's what should be impossible. Despite those 1624 contracts being delivered and closed, the open interest for January actually increased by 1,131 contracts. It ended the day with 2,155 contracts still open. Think about what that means. More contracts closed than were delivered. Yet open interest went up. That is like saying 1,600 people left a room, but there are now 1,400 more people inside than before. It violates the basic laws of accounting. The only explanation is that new buyers entered January contracts after deliveries already started. They bypassed March. They skipped February. They paid premiums to jump into a contract that was already in the delivery process. Why would anyone do that? Because they do not trust March. They do not believe COMEX will have the metal, so they are taking it now at any cost. Now let me tell you what happens when COMEX cannot deliver, because there is historical precedent. March 2022, London Metal Exchange, nickel contracts. A Chinese company called Tsingshan got caught short during the Ukraine invasion. Nickel prices exploded from $20,000 per ton to over $100,000 in a single day. Tsingshan could not deliver. They were facing losses of $8 billion. So LME did something that had never been done before. They canceled trades, retroactively. They erased an entire day of trading. Billions of dollars in profits disappeared. Hedge funds that had made fortunes overnight woke up to find their trades deleted. And the entire market lost confidence in LME overnight. Trading volumes collapsed. Liquidity dried up. Major banks stopped using LME for price discovery. The exchange lost credibility that it has never fully recovered. That was nickel. A smaller market, lower stakes, industrial metal with substitutes. Now imagine the same thing happening to silver, the metal that is in every phone, every computer, every solar panel, every electric vehicle, every missile guidance system, every satellite. The metal that China just classified as a strategic resource and banned from export. The metal that the US government added to the critical minerals list. The metal that has no substitute in over 60% of its industrial applications. If COMEX fails to deliver in March, if they announce force majeure or cash settlement, the paper price becomes meaningless overnight. Because why would anyone trust a futures contract that cannot be settled in physical metal? Why would a solar panel manufacturer hedge their silver needs on COMEX if the exchange cannot deliver? Why would a mining company use COMEX futures to lock in prices if the contracts are just paper promises? The entire pricing mechanism collapses. The benchmark that the world uses to value silver becomes irrelevant. And when the paper price dies, the only price that matters is physical, coins, bars, allocated storage, and that price is already screaming. Let me show you the disconnect. Last week, COMEX said silver was trading around $86 per ounce, but dealers across America were selling silver eagles for $120 to $150. Some dealers were charging $140 for generic rounds. A $40 to $64 premium over spot. In some cases, premiums hit 75%. That means buyers were paying 75% more than the COMEX price to get physical metal in their hands. Golden State Mint, one of the largest private mints in the country, shut down sales over the weekend. Their statement said could not secure silver, they could not get metal to sell, while the paper price said $86, while COMEX said there was plenty of inventory. While analysts on TV said the market was functioning normally, if there was real silver at $86, why would a mint shut down? Why would dealers charge $150? Why would buyers pay double the spot price? Because the physical market knows something the paper market does not. The silver is gone. It is not in the vaults. It is not at the dealers. It is not available at any price that COMEX is willing to admit. And the people who understand this are taking delivery now before the system breaks. That is why January saw 49 million ounces delivered. That is why February hit 98%. That is why traders are rolling backward instead of forward. They know. The smart money knows. The institutions know. The sovereign wealth funds know. And they are quietly draining COMEX while everyone else watches the paper price and thinks everything is fine. But here is what kept me awake last night. The bigger picture. Because if COMEX fails in March, it does not stop there. May 2026 contracts are already building. Open interest rising. July is stacking up. September is next. Every single month after March faces the same problem. Inventory dropping. Demand rising, delivery rates exploding. And once confidence breaks, once the market realizes COMEX cannot deliver, everyone will demand metal at once. Every long position, every leveraged fund, every pension that thought they owned silver through ETFs will want proof, physical proof, and there is not enough metal on Earth to satisfy those claims. Because here's the secret they do not want you to understand. The paper market created 429 million ounces of claims against 103 million ounces of metal. That is a 4-to-1 leverage ratio. 4 people own the same ounce. And it worked for decades because the 4 people never showed up at the same time. But when one person takes delivery, there are only 3 claims left on that ounce. When 2 people take delivery, only 2 claims remain. And when the 4th person shows up and finds out the ounce is already gone, the entire fractional reserve system collapses. A system built on the assumption that nobody asks for the metal. That is what is happening right now. January took 49 million ounces. February is taking 18 million. That is 67 million ounces in 2 months. 2 months that historically see 10 to 15 million combined. We are running at 5 times normal, and it is accelerating. If March takes 100 million, that leaves basically nothing for the rest of the year. If March takes 150 million, COMEX goes to 0 and defaults. Either way, the game is over. The math does not work, and every smart player in the market knows it. Now let me show you who is trapped, because it is not just COMEX, it is the banks. The same banks that were convicted of manipulating silver for decades. JP Morgan paid $920 million in fines. Their head of precious metals trading, Michael Nowak, went to federal prison for racketeering. Scotiabank, HSBC, Deutsche Bank, all convicted, all fined. Between 2008 and 2020, they placed hundreds of thousands of fake orders to manipulate prices. Spoofing. They admitted it. They paid the fines. Their traders went to prison. And 2 weeks ago, when silver crashed from $121 to $79, they closed their short positions at the exact bottom. Perfect timing. Maximum profit. I showed you the COMEX delivery reports in my last video. JP Morgan stopped 147 contracts at the low. Deutsche Bank, HSBC, Morgan Stanley, all closing at the bottom. But that was just the February contracts. March is a different story, because March is the biggest delivery month of the year. Historically, 30% to 40% of annual silver deliveries happen in March. If the banks are short in March, if they sold contracts they cannot deliver, they are about to face a choice. Buy silver at any price to cover, or default and destroy their reputation forever. And here is why I think they are trapped. Look at what happened in January. Registered inventory dropped 64 million ounces from December to February. But deliveries in January were only 49 million. Where did the other 15 million go? It left COMEX entirely. Moved to London, moved to Shanghai, moved to private vaults in Switzerland and Singapore. The metal is leaving the system. And it is not coming back. Because once you take physical delivery and move it out of a COMEX warehouse, it is no longer registered. It is no longer available for delivery against futures contracts. It is gone from the pool. And every ounce that leaves makes the problem worse for everyone still short. The banks know this. They have access to the real-time warehouse data. They have seen the delivery rates. They have run the numbers on March. They know that March is going to be a bloodbath. But they cannot cover without spiking the price. Because if JP Morgan starts buying 50 million ounces in the open market to close their short positions, every algorithm on Wall Street will detect the buying pattern. High-frequency traders will front-run them. Speculators will pile in. Retail will see the move and FOMO in, and the price will explode to $150 or $200 before they can finish covering. They are trapped between 2 choices. Default and face the legal and reputational consequences, or cover and trigger a short squeeze that could cost them billions. Now let me tell you what I think happens in the next 3 weeks. February 27th is first notice day for March. That is when holders of long positions must declare their intention to take delivery or roll forward. Based on current trends, based on the 98% delivery rate in February and the 80% plus rate in January, I expect 100 to 150 million ounces to stand for delivery in March. COMEX will have around 85 million ounces available by that date if current drainage continues. They will be short 15 to 65 million ounces on day 1. At that point, they have 3 options. Option 1, deliver everything they have and declare force majeure on the rest. Cash settlement for the contracts they cannot fill. Contract default. Market confidence destroyed. Every institution that uses COMEX for hedging will immediately look for alternatives. Shanghai, London, over-the-counter physical deals. COMEX becomes irrelevant overnight. Option 2, halt trading. Invoke emergency powers. Change the rules like they did in 1980 with Silver Rule 7. Ban physical deliveries. Force cash settlement on all contracts. Margin hikes to infinity. Destroy the longs to save the shorts. Protect the banks at all costs. This option keeps COMEX alive, but kills trust in commodity futures forever. Option 3, let the price run. Allow the short squeeze to play out naturally. Silver goes to $150, $200, maybe higher. Banks cover at massive losses, but the system survives. Confidence remains. The market believes in price discovery again, but egos get destroyed and balance sheets take billions in hits. None of those options are good. Every single one breaks something. But my guess, based on history, based on how they handled 1980 and 2011, is they choose option 2, because they always protect the banks. Always. In 1980, they created Silver Rule 7 out of thin air and banned leveraged buying to save the shorts. In 2011, they raised margins 5 times in 9 days to crush the rally and protect the commercials. In 2020, during the pandemic when silver spiked, they flooded the market with paper contracts to suppress the price. In 2026, they will do whatever it takes to protect the banks, even if it means destroying the futures market in the process, even if it means admitting the entire system only works when nobody takes delivery, because a broken COMEX is better than bankrupt JP Morgan. But here is what is different this time. In 1980, retail gave up and went home after Silver Rule 7. In 2011, retail sold at the bottom after 5 margin hikes and swore off silver forever. The price took 13 years to recover because nobody trusted silver anymore. But in 2026, retail is not selling. They are taking delivery. They are pulling metal out of the system. They are rolling backward into January and February instead of forward into May and July. They are paying premiums of 50% to 75% to get physical metal. They are breaking the fractional reserve game by demanding the actual ounces, because every ounce that leaves COMEX is one less ounce the banks can use to settle contracts in March. And once the registered inventory hits 0, the game is over. No amount of margin hikes can create physical silver. No rule change can print metal out of thin air. No emergency power can force delivery of something that does not exist in the warehouse. The banks are trapped. COMEX is trapped. And February 27th is the day we find out if the system survives or collapses. Now, I am not telling you to buy. I'm not telling you to sell. I'm not giving you financial advice. I'm showing you the math. Public data that anyone can verify. 429 million ounces of open interest in March. 103 million ounces of registered inventory now. 85 million ounces projected by first notice day. 98% delivery rate in February. 49 million ounces taken in January. 785,000 ounces draining every single day. Those are facts. CME warehouse reports. COMEX delivery data. Government statistics. The question is what you do with that information, because 3 times in 46 years they have crushed silver rallies. 1980, 2011, 2026. Same playbook, same margin hikes, same destruction. But this time, the inventory is not there. This time, the math does not work. This time, when they raise margins to force liquidations, the physical buyers will just take delivery at lower prices. And that accelerates the drain instead of stopping it. This is not 1980, when the Hunt brothers were the only major buyers, and eliminating them killed demand. This is not 2011, when retail was the primary driver and scaring them out stopped the rally. This is 2026. China banned silver exports and classified it as strategic. The U.S. added silver to the critical minerals list. Solar panel production needs 300 million ounces per year. Electric vehicle manufacturing is consuming record amounts. AI data centers need silver for every server. The industrial buyers cannot stop. They need the metal to build the future. They are not speculators who can be scared out with margin hikes. They are manufacturers who will pay any price to keep their production lines running. And the paper market cannot deliver the metal they need. So one of 2 things happens. Either COMEX defaults and physical silver explodes to $200 or higher as the paper price becomes irrelevant and physical becomes the only market that matters. Or COMEX changes the rules, forces cash settlement, and destroys confidence in commodity futures forever while physical and paper completely disconnect. Either way, the system as we know it is about to break. February 27th, first notice day. The countdown has started. The inventory is draining, the delivery rates are exploding, and the banks are trapped with nowhere to hide. So now you know what is coming.